Hi, welcome to this video day, which is about Forex technical analysis for beginners. It's a video to deal with a common problem. The problem basically wipes out the majority of beginners and causes them to lose. And it's most beginners get caught by whipsaw price action. What this means is they get stopped out too often and they can never get profitable trades to cover their losses. So give a couple of examples. They're in a long trade in a currency pair. Price just comes down, takes their stop near enough the low of the day, then price goes back the way they thought it would, but they're not in anymore. Okay. Also, when they're trying to run big profitable trends, they've got a little bit of profit. Suddenly again, they're caught by the price reaction against them. Stop is taken, and then price carries on the way they thought the big trend develops. This is such a common problem. Now, in terms of how do you solve it? Well, what I want to do is give some tips that will basically stop you getting taken out the market too frequently, okay? And also, just importantly, enable you to stay and ride a big trend without getting stopped out too soon. Now, the tips we're going to go through, they're all very simple to learn. Anyone can apply them, and I think they'll be a great help for anyone suffering from this problem. So what we'll do is we'll go to a storyboard and review them. Right, let's have a look at 10 tips to help you not get stopped out too frequently or whipsaw moves, and also to help you hold big trends for longer. Now, let's start with a very basic point first of all, because most beginners make this mistake. Do you know what your strategy's edge is? Do you know why you're going to win when 90% of traders lose? And do you know the logic, and have you researched the logic that edge is based upon? Now, most beginners don't do this, okay? What they'll do is they'll simply just take a strategy from someone online, just think, well, it's going to work. Guy says it's going to work. And most strategies, ways of trading promoted online in terms of technical analysis don't work. I'll give you some examples. If you're using a predictive strategy, one of those pattern strategies that does all those endless lines going to the left of the chart, it's an advanced trading strategy, or it's a short-term trading strategy, trading off a 30-minute chart, an hour chart, it won't work. Okay, I can tell you that from 30 years experience, okay? And if you research the logic yourself, you'll find the same conclusion. Obviously, you can't predict the Forex markets. They don't move to pretty patterns. And if you go too short term, you're just going to end up trading random noise, okay? You need to find a strategy with an edge. There's plenty of different ways of trading. If you were to look at, let's say, my trades in relation to my strategy, the actual edge is known, it's defined, it's been researched, it's worked for many years, it will always work. Now, I'm not saying you should trade the same way as me, everyone's got to find a strategy that suits them, but make sure you do your research, otherwise the next 9 tips won't help you because you'll just lose. Okay, right, let's go through the rest of the tips. Point number 2. FX pairs always trade high volatility trending markets or low to high. I'll come to low to high in a minute. If you take most Forex pairs, they spend probably about 70% of the time trading sideways, choppy action, only 30% of the time really trending strongly, and you want strong trends. That's what all professional traders do. They want high volatility, fast moving price. Now, most beginners make the mistake of only trading a few pairs. Some will just trade 1 or 2, like let's say Euro USD and GBP USD. That's a huge mistake. If you want to not get stopped out too frequently, you want to be trading moving pairs. So look at more pairs. It's a very basic point. Plenty of great opportunities in the crosses, major crosses, and even in the more minor pairs. I would monitor at least 20 pairs, okay? If you monitor 20 pairs, you've got a soundly based technical strategy. All charts are the same, aren't they? They're all the product of human sentiment or trader sentiment. So if you can trade one pair, you can trade them all. I personally look at up to 40 a day. You just increase your chances of finding good trade setups. Okay, so look at as many pairs as you possibly can. Point number 3, risk to reward is not stop v target. A lot of traders do this. They'll say, right, I'm risking 50 pips to stop, 200 is my target, my risk to reward is 4 to 1. No, it's not. It's just a trader's opinion. And too many traders make this mistake. What they do is they put the stop too close to maximize the risk to reward. There's no point most of the time in using a 50 pip stop. You hear a lot of people say use 50 pip stops, 30 pip stops, you can make money. Not in my experience, and I'm sure most professional traders would say the same. You've got to use realistic stops, which comes to point number 4. And this is to do with the daily volatility. If you look at most pairs, daily volatility, 100 pips or more. Certainly if it's a market you're looking to trade and you want higher volatility. So if you use a stop of 100 pips, you're going to be within a daily range. So it's not a good idea most time. You need to give enough room to your stop to allow you to stay with a trade. A lot of people say, well, could I really do 100, 150 pip stops? Sounds like a lot of risk. No, you just cut the trade size back. Because, for me, if I'm using that stop, or that stop size, I'll be looking for 300, 500 pips or more on the other side. So you've got to be realistic with your stop, so you will get taken out. And this leads also on to point number 5. Don't put your stop at an obvious level. Okay, and a lot of traders just put their stop behind near-term support or resistance. They get taken out, the price rebounds back the way they thought, and a lot of the time you'll see them blame their broker. It's not their broker at all. It's more likely to be an institution hunting retail stops. There's plenty of big funds that do that. They know that all traders, or most traders, are going to go for the obvious stop level, as they push price towards that level, take the stop cluster, and then the price rebounds the other way. If I'm looking at a chart, I'll see the obvious level, and I want to be one level back from that obvious level, so out the way of the stop cluster. Okay, this leads on to point number 6, which is understand round number turbulence. A fatal error that beginners make is to put their stop right on a round number, or within a few pips either side. Now, institutions, this is where they really go and hunt stops. If you look at turbulence around round numbers, there's a lot of it. Institutions are hunting the stops. If I've got a stop behind a round number, it would depend on the pair, but I'd normally give it at least 20 pips, normally 30 pips back, to stay out the way of the noise. And that's the same for a trade entry through a round number as well, because of the turbulence around them. Okay, now point number 7, moving stop to entry, a common error. A lot of traders, what they do, as soon as they've got some profit, they basically say, right, I'll move my stop to entry. I can't lose. It can only go in my favour. And they put it too close. They're too frightened of losing money. Now, if you're too frightened of losing money and always want to move your stop to entry, you just are not confident in your strategy's edge. I mean, you can do it sometimes. I do it rarely, occasionally. Most of the time I won't do it, because if I get stopped out, sure, I haven't lost any money, but the trade, a great profit could be missed. It's no point in doing it. Okay, trade stalls, switch to another pair. You get this a lot, actually, where you come into a trade, the volatility increases, then suddenly it stalls. Okay, so it drops. Very often, you are best either to liquidate the pair and go flat, or if you see another trade setup that looks better elsewhere, go for that. I normally find that most of my trades come right pretty quickly, so I time them. They stall normally within a few days. I will come out, look for another pair. It doesn't matter if I've got a small profit or a small loss. You know, I always view you're trading the market, so you're looking always for the best trade opportunities. And a lot of traders will stay in a trade deep down. They know it's probably not going to go in their favour. The price action has changed and they'll just let themselves get stopped out. I always try and avoid that. Point number 9, should use simple sentiment analysis. My answer is yes, you should. And the reason for this is, you know, the chart is a reflection of the sentiment of traders. So if you know the sentiment behind the chart, the technicals, you get advance warning of what might happen. So for example, let's say in terms of point number 10, you've got very bullish sentiment towards the Forex pair, and the price action has been going up strongly, then suddenly it stalls and loses momentum. Well, chances are it's probably going to turn the other way. If you know the sentiment behind the chart, that's giving you advance warning. That's just one example. But most professional traders today will use some sort of sentiment analysis to help them with their technicals. It's not difficult to do. We've done, you know, numerous videos on this. So they're the 10 tips. I think what I would say, just to conclude, is, yeah, what you've got to do when you're trading is do what other traders don't. You know, so use realistic stop levels from the price. If it's obvious, it's obviously wrong, okay? And keep in mind that institutions are there specifically to take out retail traders. It's just what happens, okay? Make a lot of money out of it. So I think, you know, with these 10 tips, you know, they should help you if you're having a real problem with getting stopped out, you know, right at the low, right at the high, and not being able to hold a profit. Then they will help. When you're trailing stops, always keep them back behind the second level most of the time until you get into the end of the trend. Then you might want to push your stop up close, okay, or closer. But be patient and trail the stop slowly. If you're in a big trends can last a long time. And you know, it's not often, but we will catch you know, trades that sometimes run 500,000 pips, even more. We're very patient with the way we deal with our stops. Careful not to move them too close. Right, that is the video for today. Hope you found the tips helpful. Thanks for watching me as usual. Take care. Have a good day.